Resurgent India Knowledge Series presents virtual session on role of domestic limited partners in fueling Indian startups. Mr. Ashish Agrawal, Director, Resurgent India Limited. Chartered accountant and management graduate Ashish Agrawal has a rich experience of more than 25 years in financial sector. He has an extensive knowledge in credit and investment banking, corporate finance, capital market operations, foreign exchange services, debt syndication, wealth management and financial advisory services. Mr. Dinesh Goyal, Partner, Siana Capital Management. Varied and senior operational management and consulting experience of over 25 years, active angel investor, mentor to deep science and tech startups, IoT-based solutions, online fraud detection, mobile data analytics and 3D printing of human organoids, strategy consulting experience of 10 years at Accenture advising large Indian and multinational companies on their growth strategies and change agenda, partner and India Managing Director at IST Incorporated leading both India business and operations in the immediate past corporate role. Mr. Sunil K. Goyal, Managing Director and Fund Manager, Your Nest Venture Capital. Tall and lanky but with the memory of an elephant, Sunil is the mental repository of every major development in Your Nest, which he co-founded in 2011 after a successful corporate career working closely with the fourth-generation entrepreneur family of Adabar and the founders of Bharti Airtel. Before becoming a full-time, early-stage investor and fund manager, he had gained comprehensive experience of leading complex projects in the areas of M&A, business turnarounds and strategic partnerships. Sunil also continued to be an independent director on the board of select Bharti Group entities until recently. Mr. Amit Singhal, Founding Partner, Fluid Ventures. Amit Singhal is a qualified chartered accountant with 18+ years of work experience across varied industries. He has an extensive experience in funds administration, accounting, investor reporting, strategic planning, product pricing and budgeting. He is very active as a seed stage investor in Indian startup ecosystem and launched Fluid Ventures, a D2C focused SEBI approved VC fund in year 2021 to invest in early stage startups. He is founder and director of ASR Business Advisors Private Limited, www.asrindia.co.in. ASR works with multinational companies for outsourcing their finance function to India. Mr. Alok Patnia, Managing Partner, TMG Global. Alok Patnia is the Managing Partner of TMG, Tax Mantra Global Group, a digital-first global tax and legal firm, providing transaction advisory, financing support, CFO support, global expansion and business operate support in India, Singapore, US and Dubai. A chartered accountant, ex-KPMG and F. Alok has 20+ years of experience in global tax and structuring, investment banking, mergers and acquisitions and growth strategies. Mr. Chirag Shah, Senior Vice President, Black Soil Group. I have over 14 years of diverse experience in investment management, fundraising, business development, restructuring, investor relations, investment banking, and financial consulting. Throughout my career, I have achieved numerous accomplishments and have an exceptional track record of professional performance. I am currently assisting in sourcing investment opportunities, managing transactions, structuring deals, and managing assets in the alternative credit space. I have led successful investments of over 350 Indian rupees in healthcare and pharmaceuticals, mobility, and financial services. Mr. Brijesh Damodaran, Managing Partner, Axano Capital. Brijesh Damodaran is the co-founder and Chief Investment Officer of Axano, a growth stage venture capital firm. At the company's helm, Brijesh works closely with the investments team in shortlisting investments for the portfolio. Besides, he actively works with the portfolio companies on building their matrices and supporting their growth, fundraising, and M&A strategies with a sector-agnostic approach.
Yeah, good evening to all, and greeting from the Resurgent India Limited, and very warm welcome to all the panel speakers and the August gathering here online in this today's webinar, the virtual session on the role of domestic limited partner in fueling Indian startups. So, friends, we have very good panel speakers. They'll speak on the topic in detail. But before that, I would like to just set the tone regarding this topic. So you know that the prolonged funding winter that has seen a significant decline in the investment in Indian startups. But the limited partners, LPs, have continued play a crucial role in propelling their growth through their judicious allocation of capital to venture capital firms, VCs. LPs provide the much needed financial resources for startups to navigate various stages of growth. So they are investing directly in the startup, or they are investing through AIFs. In recent years, we have seen that various types of LPs, including pension funds and family offices, have acknowledged the immense potential of investing in the Indian startup ecosystem. And the participation of pension funds not only brings significant funding, but also adds credibility to the startup ecosystem, generating further interest from both domestic and international investors. Moreover, there have been a notable shift as LPs increasingly make direct investment in startups ventures, and from the traditional approach of indirect funding actually. So LPs are now allocating fund to the startups directly along with the investment in the IFs. And this webinar focuses on the role of LPs in supporting Indian startup during the funding challenges. And it brings together industry players, policymakers, experts, and all stakeholders to share experience and exchange ideas. The key discussion points which we want to highlight, we want to take up here: the role of family offices and domestic institutions in the startup ecosystem, ways in which startups and corporates can find synergies while working with each other, corporate expanding portfolios via the AIF route, and direct investment in private markets. Government supports the startups ecosystem through fund of fund and other measures, and support for growing startups, potential capital, from the long-term perspective, and the strategic guidance from corporates and the family offices. So overall, we'll cover up this topic in detail along with our panel speakers. Those are experts in the field. They are the veteran of the industry. And I hope so that our audience who has joined here, and they will be knowing more about the topic. And this will help to bring more and more capital to the sector. And this message will go to the all stakeholders, from the government to the all other stakeholders. So we have a very good panel. But before that, I would like to just highlight this AIF industry, not very old in India. It may be almost 10 years which has completed, and in 10 years it has grown like anything. More than 1100 AIFs are there. They have invested in thousands of startups. Government has supported. Government has also come out with some of the fund of funds which are investing in the AIF. And other than that, the lot of exits we have seen also. The investors who have invested money and they got the money back also. but there are challenges also, there are opportunities also, which we will
Are we connected?
Yeah, I can't hear Ashish.
I think he freezed. Yeah.
Yeah.
Sir, there's some connection issue with she said just give me 2 minutes.
No problem. We can initiate the discussion until then.
Yeah, sure.
Yeah, Ashish is back.
I'm sorry, there was some, I think, technical glitch.
No problem. Continue.
So I'm really very sorry for that. So we have Mr. Dinesh Goyal, who is from Siana Capital. He himself veteran in the industry. So Dinesh ji, I would like to invite you for the panel discussion, and we would like to understand from you about your fund. What are you doing actually? And then we would like to understand about the some areas of this topic, that how has the utilization of the AIF route impacted the overall investment landscape for the domestic limited partner actually, and what changes or trends have emerged in this current scenario in the domestic investments, and how is government supporting the startups ecosystem by pumping capital through the institutions like SIDBI or maybe say SRI fund. So government is also doing a lot actually. So over to you, and we'd like to understand from you, how do you think on these two questions, and you can brief about your organization also so that people should connect. Over to you, Dinesh ji.
Okay, good afternoon, everyone. Good evening, actually. It's past 4 p.m. Thank you, Mr. Ashish and Resurgent, for inviting me and having me here for this panel discussion. So brief about ourselves. We are a primarily early stage deep tech investor. So we also invest in sciences space, which has nothing to do with technology or telecom, but largely focused on technology, products, platforms, and things like that. Primary focus is on emerging technologies. No need to go through all the list. I mean, all of us are familiar with what the emerging technologies are. As a fund, we avoid investing in consumer plays. As per our thesis, we don't do direct to consumer. We don't do FMCG brands. We avoid B2C businesses. We avoid businesses which require a significant amount of capital just to acquire customers, retain customers in sales and marketing, and so on and so forth. So we prefer B2B businesses. So we prefer products and platforms which are either solving a problem which hasn't been solved before, or which are category creating in some shape or form. As far as sectors are concerned, we do have preferred sectors such as healthcare, logistics, industrial space, manufacturing, industrial IoT, and so on and so forth. But we are in character sector agnostic. So we look at more the compelling opportunity from which is aligned to our focus areas. We are on to our second fund now. First fund we raised, despite COVID, we could manage to raise, we actually flew in the face of COVID while raising our first fund when the lockdown started, but we managed to raise about 200 crores in the first fund. And we deployed that last year, built the portfolio. And since last year, we've also started raising our second fund. Just recently, about 60 days ago, we did our first close of the second fund. In our second fund, we've already crossed the corpus that we raised for the first fund. So the target is obviously much larger. We hope to raise about 400 odd crores in the second fund, but we've already raised over 50% of that. And now we have just recently started deploying from our second fund. We typically do A series transactions, sometimes a little bit before, sometimes a little bit later, but focus is typically 10 to 15 crores as the first check. And our style is to lead transactions. We prefer to lead transactions or co-lead transactions, and we prefer to have a more active role with our portfolio by taking board seats and rights and so on and so forth. So that's about us. Now, coming to the question that you asked, I think domestic capital has a huge role to play in the Indian ecosystem. As you pointed out in your opening comments, Mr. Agarwal, the industry has grown many fold. And I'm sure Sunil and few others will cover that because Sunil has been around, right, I would say probably from the inception of this industry in India. So it's grown many-fold, and all of us believe unarguably that the industry has just started. It has a long way to go. In the next 3-4 decades, I think the industry will be huge industry because India never lacked the entrepreneurship appetite, and India never lacked the talent. The issue was the talent was actually going abroad because we didn't have an enabling environment. We didn't have the access to risk capital, and we did not have the democratization and access to tools and technologies or telecom networks and so on and so forth at a cost and access that people could sit here and innovate. So all that has changed, and it's an irreversible change. So I think the industry will continue to grow. As expected, because it was a nascent industry in the last 10 years, we have grown largely on the back of foreign capital, foreign institutional capital, foreign capital in the form of HNIs, institutions, friends, development institutions, and so on and so forth. And whether we like it or not, they continue to play a dominant role as far as the nurturing and supporting this industry is concerned in India. But if we plot the trend, statistically, the data speaks that the role of domestic LPs is growing. And in no small part, fueled by the current government of India, led by Mr. Modi. I mean, the SIDBI Fund of Fund 10,000 crores, which was launched 5-6 years ago, has played a pivotal role in funding this industry, in nurturing this industry across different stages. I think almost every second fund, VC fund, has been funded by SIDBI at this point. Over 100 funds have been funded. So very high percentage of funds have been funded. And we believe, as per our interactions and in the media, that SIDBI is soon looking at getting an allocation of another 10,000 crore from the government. It's in the works. Similarly, SRI that got started by government. Similarly, there are many other institutions of government and banks which are also supporting this ecosystem, both directly as well as indirectly. But the private domestic capital, I would say, is still quite small in relation to the size of the country that we have and the availability of capital that we have. Things are changing, but I think there's a long way to go. Increasingly, new age capital defined as people who have become wealthy either through this ecosystem because they've had successful exits, they set up startups 5-10 years ago, and things of that nature, is very active in redeploying that capital and supporting the entrepreneurship ecosystem in India. But interestingly and encouragingly, even the old capital, the industrial houses, which are 3 or 4 generations old, they are also setting up family offices, and they are engaging professionals, and they are looking at some percentage allocation to this asset class as part of their portfolio. It is not just limited to real estate and fixed deposits in public markets. Every family office is increasingly looking at allocation to AIFs in terms of private credit and private equity access. So it's going to grow. The ecosystem is going to grow, and all these players will play an increasingly more important role. And I think India will be in a spot few years from now where domestic capital, just like we saw that in public markets, if FPIs and FIIs pull out money from public markets, we don't see such a dramatic fall because it is supported by the domestic capital, public markets. I think we will see a much higher proportion of domestic LPs, including private capital, getting routed to support the startup ecosystem through AIFs, as well as you pointed out, also through direct investments in startups. So let me stop there. I think I've covered those questions. I'll be happy to sort of add later to some of the points.
Very good points which you have told that the flow of domestic capital will improve from the government point of view or from the private investment point of view. But they'll keep investing directly also and through AIF also. So it's not like that the money will go in one way only. And it should happen also. You're right. So thank you very much, Dineshji, for your views and which are very, very important for all of us. Now we have Sunil Goyalji. He's from he's managing partner of Yournest. As Dineshji told that he's in the industry since inception actually. So he has seen all the phases of the industry and you are part of it also. So Sunilji, first of all, I'd like to welcome you this webinar.
Thank you.
Thank you very much for joining with us. So, sir, we would like to understand about Yournest journey a little bit, and then there are some relevant questions which we like to take up with you, keeping in mind your experience. So, one good thing which we like to understand is this: in your experience, what are the critical considerations? Because many times when we are interacting or you are interacting with LPs also, there are a lot of questions in their mind, basically how to evaluate, how to invest, when to invest actually. So, what are the critical considerations that LP look for when embarking on the investment in AIFs actually? And the another question which you like to ask from you that can you provide insights into the evaluation process followed by the government fund of fund actually? Because there are some set norms also allocating fund through the fund of fund like SIDBI and SRI fund actually. So these two things are there, but you are free to add as per your experience so that the industry should get the benefit of it. Over to you, sir.
Thanks, Ashish. Delegates, when this mail came from Ashish that he's doing a panel on this particular topic, within seconds I said yes. Even in a sleep, I can talk about this topic, and the reason I can do so, 2001, I was part of Bharti Airtel, and that time Warburg Pincus came and invested around $300 million in the company, and within 4 years they went back with $1.8 billion. While the contribution for Airtel and every team member was celebrated inside and across the nation, somewhere I was saddened. I was saddened that why not a single penny was made by an Indian investor in an opportunity as large as telecom, in an entrepreneur as good as Sunil Mittal. And this became a basis for me to conceptualize Yournest. And the reason Ashish has invited me here is we have a base of around 300 investors across 3 funds now. In the last 10 years, Fund 1 was 80 crores with 140 individual investors. Fund 2 was 215 crores with around 80 investors. And now the 750 crore fund has more than close to 150 individual investors or so, including institutions that Dineshji talked about. Keep in mind that what is the evaluation criteria? Ashishji, the evaluation criteria between an individual family office or even an institution does not differ. The only thing that we've been able to establish consistently is that at Yournest, we've been top tier fund. And family offices, individuals, please keep in mind, there is a benchmarking report that comes in from CRISIL, Preqin, as well as NSE. And that benchmarking report gives us the data as to how the funds are performing. Happy to inform that all 3 funds are continuously top tier performing funds. Fund 2, as per CRISIL, amongst the 29 funds of that vintage of 2017, ranks 4th. The Fund 3, today of 2021 vintage, ranks 3rd amongst the 33 funds. And across 388 funds that are reporting data to SEBI, we must be amongst the top 5% of the funds on the overall performance. Now, the purpose of any evaluation is to determine which fund can be a top tier fund. The first criteria that goes in the minds of them is the institutional approach to investing. You cannot have a fluke in your portfolio. The judgment that one has to make is, can you deliver that consistently? And what is your investment process? How do you evaluate? Which all partners are involved? How the analysts prepare the report? How the investment case is looked at? How the risk assessment is done? And where all the team has walked away from a transaction by saying that we don't understand this particular space. And if they've invested in a particular space, what authority they have to be in control of the future of your money are the aspects that they try and understand as to how institutionalized your approach is. The second aspect is, are you sticking to your investment thesis? We've come across family offices who have made even 10x and 11x returns on some of their fund investments of 2011-12. And when I go back to them and ask them whether they would like to invest or continue to invest in that fund that has given them 10, 11x return, they say no. The reason they say no is because they did not stick to the investment thesis that was defined. The way Dineshji said that he's looking at deep tech and deep science and these kind of businesses, if we are sticking to that thesis, institutional investors and family offices are happier. It cannot be that you are saying this is a pharma mutual fund, and the definition of pharma tomorrow you extend it to healthcare as well. Okay, yes, it's a fine line, but it is better that you keep your investors informed of what you want to be doing and how you want to be doing it, and why do you think that particular sector, that stage, that country, that geography is going to be giving disproportionate returns. So that convincing ability needs to be there. Now, for people who've been there in existence for more than 5-6 years, exit has become the norm. If you have not returned 1x of the capital back to the investors, some of these institutional investors don't talk to us at all. International investors, they wait on the sidelines till the time you've returned a significant amount of capital back to the investors. They say exiting is the most toughest of jobs, and we know that's the process that all of us are learning in this Indian venture capital ecosystem. The ones who've been able to demonstrate giving cash back to the investors are being loved by the LPs. We had National Infrastructure Investment Fund. They wanted to develop a thesis of investing in venture capital. We worked with them all along their conceptualization of the idea 4 years ago. And now they are anchors in our Fund 3 with 20% capital coming in from NIF. And first time they've invested in venture capital. Reason they've invested is they saw DPI. DPI is distributed to paid in capital. So the moment you've started distributing capital back to the investors, you can get into reckoning out there. How do you do it, and where do you do it? When do you do it? For us VCs, we have to be very, very clear that what role we are here to play. Let me give an example. We are a pre-Series A investors. We invest normally $1 million in a company. If my $1 million invested in a company in a first round has become, let's say, $7 to $10 million in a period of 7-8 years, and I sell that particular $1 million stake at $7 million, let's say 7x. There are options with me to keep sitting on that asset, launch an opportunity fund, launch another fund, and keep nurturing that asset and say this company is going to be, the 7 million is actually going to become $50 million in the next 5 years. Whereas I can go back to my investors and tell them, no, my role is not to seed and warm an investment which is already grown. My role is to sell that asset for $7 million, give the money back to my investors. Investors will have a trust in me. Maybe they'll pull back $15 million in my funds, use that $15 million to nurture 15 more startups. Our specialization is to nurture young startups. So that's the role that they want to see. So with these words, I think I've given some examples to you, Ashish, for your listeners to think through how to go about evaluating and how the family offices are evaluating institutions like us.
Thank you, Sunilji. Thank you very much. I think you very well covered one part, which second part of the second question actually, which is how the government funds are evaluating. So this can be helpful to the domestic LP, which are the family offices and all. So they're in different criteria which they are following, or they can highlight on that.
Definitely there. Ashish, these three are definitely there. The thing that they look at, because there's a first-time fund managers, they are coming and reaching and they are supporting them. They want to see the first-time fund managers' ability to raise at least 50% of the target fund corpus. Government has been a little disappointed with many of us who have not been able to raise the capital that we were scheduled to raise. Even I failed to do that in one of the funds. So if you are consistently failing on that we said that I'm going to be doing a 200 crore fund, actually end up doing 150 crores. So there is out of the 10,000 crores allocated by the SIDBI fund of funds, 25% of the capital which was allocated to us couldn't be drawn just because we've not been able to raise enough capital. So the criteria that they see is that you have a capability to be able to raise the capital that you're aspiring to raise. So that's the only additional point I'll put in, other than the investment committee's institutional approach and other things.
Thank you, Sunil. Thank you very much. Very well said, actually, and covered very well that some benchmark reports are available of the funds which can be looked by the investors or LPs, and the approach, how they are investing, and basically the returns also in the past, how they have given the return to the investors. Actually. So good, sir. Thank you very much. Friends, now we have Amit Singhal-ji, who is from the Fluid Ventures. Amit-ji is also having very good experience of the industry. So Amit-ji, first of all, I'd like to welcome you and thank you very much for joining with us in this today's webinar. Sir, we would like to understand from you a little bit about your fund, and then there are some questions which are related to the topic. This regulatory is playing a very important role for the bringing the investments in the AIFs, the industry. So the regulatory uncertainty can make it difficult for the investor to understand the legal framework and make informed investment decisions. Have regulatory and bureaucratic hurdles increase LP hesitancy in investing in the startups or the AIFs? And second question is, which industries have yielded or given the more return, the best return for LPs investing in startups, and what factors have contributed to this success actually? So these two questions are basically different actually from the regulatory point of view, whether this India regulation is conducive for investments, or the another is the industry return from the different industries to the LPs, either direct investment or through the IFs. Over to you, sir, and thank you very much.
Sure. Thank you very much, Ashish ji, for inviting me here. So I believe from the fund perspective, Mr. Dinesh and Sunil, who are the legend in this industry, have speak in detail about this. So we are a very young fund. So I launched this fund in June 2021, and on 31st May we have completed our 2 years. And we invest at pre-series A, early stage investment, but our fund thesis is that we only invest in direct to consumer brands. So I'm a guy who's known as a D2C guy in India, and we are one of them who invest at very early stage, not at even series A level. So our fund is 50 CR crore. And the good part of our fund is that there are 36 LPs who are contributing 50 crore. Our call for money is separate, means we are calling for money over 4 years. So we are very slow in investing. Till now, we have deployed 25 CR out of 250 crore rupees, make 9 investment, and 36 investors, all are individuals. There is no institutional capital, no corporate, nothing like that. All are CXOs of large companies or the startups. And 80% of them are those who are the first time investor. They have not made any investment prior to this fund. So you can understand from the SEBI perspective, when I sent them the public placement memorandum, which is the Bible of our fund, which everyone had to read, and the contribution agreement, which is 100-pager agreement. And when they have to read it, so I normally say that in case someone will read that, he will never invest. It means everything negative is written over there. Nothing is positive mentioned there. However, SEBI is also right, because they have to cover all the points. So it is very difficult for individual investor to invest in a fund because of Indian legal framework. On the same side, the changes are happening very frequently from the SEBI side. Every week there are frequently circulars are coming where they are changing the things on the, and it is applicable on the fund which are already in there in existence. And when we go back to the LPs and say, okay, now SEBI is asking this document is also required. Now we require more documents. Be little bit upset and not very comfortable that why so much changes are happening, whether we are into the right fund or not. So that's how that increase their untrust on the funds, and they start looking for other asset class. So I strongly believe that in India, if there can be master circular by the SEBI, just like RBI, which can be published on the periodic basis, it can really help the fund manager as well and to the LPs as well, where they can learn about this asset class. They can see that these are the documents which are must, these are the processes we will have to follow, and it will increase the trust in the investing in the startup through funds as well. So I strongly believe that little bit improvement is required. It will definitely help the fund manager and this asset class to grow very well. And related to your second question, which is which sector is best, I believe there are many sectors which have given good kind of return. But again, the sector is not the criteria. Fund is the criteria, and fund thesis is the criteria. As Sunil rightly mentioned, that fund manager has played significant role there. At what time you have to enter, and exit is extremely important for them. That because unless and until you will take a decision of exit on the right time, you will never be able to give the right kind of return to your investor. So there are many sectors which are good, but still fund manager failed to give the right kind of return to their investors. There are sectors which didn't perform as well, but still people have made right decision at the right time, and they make good money for their LPs. So it is all about fund manager perspective that what is the fund thesis. And again, I will go with Sunil's thesis that he should be stick about that. Whatever is the thesis, he should not be play around that. Okay, this is an opportunity now. Let's widen the scope of my fund or the thesis. In case you have decided that, take an example, our fund thesis is very simple. We will invest at seed stage. We will again invest at Series A level, and we will take an exit at Series B level. So that is the simple philosophy of our fund. We will not take exit before that. We will not go beyond that in terms of investment. So fund manager will have to follow their thesis, and based on that, there is a return. There are benchmarking study available in the market. We can see that which funds are doing well, and based on that, people can take the decision. Thank you.
Thank you, Amitji. Thank you very much. I think you are very well covered. There should be some kind of uniformity in the regulation, so that there should not be any discomfort of the investors. And I should rightly give the suggestion of master circular. Yes, sir, please.
Team, the SEBI regulations do disturb us when they come so frequently. Every week there is a circular or so. But let me tell you, this is all happening largely for the good of the individual investors. I know from 1996 guidelines of venture capital to 2012 AIF, the kind of transparency that SEBI happened to bring into the asset class is multiple times better than what RERA is doing for the real estate sector. Because of this transparency, look at the size of this industry. It is today 8,33,000 crores under management between category 1, category 2, category 3, and category 2 is like 5,50,000 crores out of that. It is the trust that SEBI has been able to bring in. And just to strengthen that trust, they are bringing in some changes, which is very, very tough, very, very hard for us to follow, because as Amit mentioned, it is happening in mid-course, in the midstream, while we are flying, or we have to build the parachute because the changes are taking place. Overall, since they are in good spirit, let's live with it. Our investors are happier and should be happier that every time something that comes in is actually for the overall interest of them. So some pain for us, we are existing fund managers, but the system is solid, rock solid, to keep giving trust to the family offices.
Great, sir. Great. Very good suggestion or very good feedback also. The only thing which Samitji has told that there should be a master circular. So I think if we can work out on that also, that will be helpful to keep all things at one place actually. So thank you, Amitji, once again. Friends, now we have Alok Pataniaji. He is from TGM Global. So Alok ji is himself investor also, and he is expert in tax and other matters also. So Alok ji, first of all, I'd like to welcome you and thank you very much for joining with us. And Alok ji, you'd like to understand about little bit from your organization point of view. Then there are some questions which are very, very relevant actually with this topic. So the exit is important for any investment. Exit should be the first question actually, as Sunil ji has also told. So what are the possible exit scenarios for domestic LPs? and how liquidity can be enhanced by providing a secondary market in case of AIFs. So that's the one thing, because today there is no practical organized secondary market for the AIFs units actually. And the domestic LP are still hesitant to invest in volatile startups ecosystem. What are the measures taken by fund managers to provide them comfort to increase their portfolio allocation to AIFs? These two questions are there, which we'd like to understand from you. And thank you very much. And over to you, Alokji, sorry. Alokji, you are on mute, sir.
Thanks, Ashish ji, and thanks, Resurgent Group, and thanks everyone for inviting me for this very insightful webinar. And just a little bit about us. So we are a global cross-border tax and legal firm. We focus mostly on cross-border, founder-driven, funded, non-funded companies. I started this company in 2009. Prior to that, I was working with a big accounting firm for 7 to 8 years. So in total, been working with tech startups and cross-border businesses for close to 2 decades now. And something happened in 2008 wherein, so I was working in Bangalore with KPMG, and I could see Snapdeal and Flipkart coming up in Koramangala, and every day there is a talk about new startup. And I thought that why don't I build something of my own? And I quit and came back and started Tax Mantra Global, which is the TMG Global. It's been 13 years of journey. We do India, Singapore, India, US, and India, Dubai cross-border work. In fact, we work with Singapore government also in detail. Uh, as you said that I also invest a lot. Since 2015, I have made a lot of investments in my personal capacity. And in COVID, with my partners in Singapore and Dubai, we started a syndicate fund out of Singapore, which is called Profit Board Ventures, wherein we pull in money from our friends and put it in Indian and the Southeast Asian startups. I have also been promoter, non-working promoter in some of the large startups which have become large now. So it's been so my life totally consumes into startups and founders and entrepreneurs. That's how I put it. And coming back to the question, Ashish ji, which you have asked me, and which is very very relevant, because now we are in we have spent 10 to 12 years, 14 years in the Indian startup ecosystem, in a sense that we are going into the next stage. And when we go into next stage, we start talking about exits, right? The single most large exit which happened with Flipkart, and since no startup ecosystem will really grow till the time the domestic local money doesn't get into that ecosystem. That's what happens in US, that's what happens in other large startup ecosystem. And it's high time that we also have our own domestic money getting invested into startups. And Sunil ji rightly said that it is very important that our own money gets invested into startups, and we also get the opportunity to earn that kind of return, right? So I think exit is becoming very important now, as we kind of get into the journey of the startup ecosystem in India. And I to my mind, there are a few options wherein there are exit for domestic partners in AIF mode, and there are several possible exit scenarios which I can talk about. The number one which comes to my mind is IPO. And IPO, starting with Zomato and other successful IPOs, even though we had some disappointments also. But however, considering the current market scenario, I believe that once the valuation at the initial level pre-IPO gets kind of realistic, the IPO will also start working for startups. So IPO can be one of the very very important way of exit. The second is merger and acquisition. And I personally feel that as Indian startup ecosystem matures and more products and more services are being started and scaled up, there may be many scenarios wherein merger and acquisition will happen. There may be scenario wherein a product is very good, but product has still not found out the monetization value to that point, and there are some strategic investment either from a corporate or from other startup who want to buy that product or service. So merger and acquisition will really kick in Indian startup ecosystem in next 10-15 years. That's my view. Secondary sale is also which involves selling the IP's ownership interest in the AIF to another investor, such as secondary market buyer. And this can provide liquidity to LPs who wish to exit their investment before the fund designated terms end. I think other interesting aspect, which is very popular in US, is buyback by the general partner. So some AIF may have provisions that allow the GP to repurchase LP's interest under certain conditions, obviously under the compliance of the regulatories, right? So these are some of the exit options, which to my mind comes when we talk about domestic LPs. And there can be many ways in which liquidity and facilities secondary market transactions the IF can explore, mainly thinking about establishing a secondary market platform. So I always feel that in India we should have a platform for secondary market in startup. There has to be a platform wherein if I have invested, I should have an option to go and create and get an exit, right? In terms of, so LPs can buy and sell their ownership interest in the fund. They can partner in with secondary market providers also. And there may be another option which, subject to compliance, is AIF can offer periodic liquidity windows, whereas LPs can submit requests to redeem and sell their interest at predetermined intervals. So I think these are important. These are some of the important ways wherein the exit and the liquidity options can be found out for domestic LPs, as we think about. Ashish ji.
Thank you, sir. Thank you. Thank you very much, Alok ji. I think you are very well covered. Basically, M&A and IPO route, which is I think more suitable route actually, which should be there. And this the secondary market for AIF, as Sunil ji has told, 8,50,000 crore is not a small amount actually. So there should be some I think platform for the liquidity for the investors. Because many times, although the investors are looking for investing for long term, but there may be some requirement in between because of some regions. So there should be some kind of healthy platform where they can have the liquidity, they can have the option to exit, where the others can also come and they can take part in that actually. So thank you once again to Alok ji for giving your insights. Friends, now we have Mr. Chirag Saha, who is Senior VP in Black Soil. So Black Soil, a well-known name in the industry. They are also in this business in the last many years and funding to various category of the assets. So first of all, Chirag ji, thank you very much for joining us at this webinar. So we'd like to understand a little bit about your fund, this Black Soil organization, and then there are some questions which we'd like to understand from you, which are related to this topic basically. So what kind of IRR have been generated by AIFs? Because any investor is looking two things. One is exit, another is return. So the return is very, very important. So what kind of IRR have been generated by AIF for the domestic LP last 10 years through AIF route, according to you? And the another question which we have is how can private and PSU banks, so the participation of the banks is also, because banks have a lot of money, a lot of deposits from the investor, and how private and PSU banks can come forward to support a startup through investing in AIFs. And according to you, which asset is more preferred by the domestic investor, venture capital or venture debt? So we like to hear your views on that also. So sir, over to you, Chirag ji.
Good evening, Ashish ji, and thank you everyone. Thanks Ashish ji and Resurgent team for inviting me to have this discussion. Firstly, to start with, I'll speak about what we do. We are an alternate credit platform. Black Soil as a group, we are an alternate credit platform. We provide debt. Unlike the panel over here, who's more of an equity investor, a VC investor, we provide debt to growth companies, startup, and NBFCs or financial institutions respectively for a period of time to get a kind of a payouts on an amortizing model. That's what we have been doing for last 7 odd years, right from the day we've been started funding startups. But our journey goes back a little bit. We started ourselves in 2013 with the first AIF. When was the initial AIF regime started? We started with real estate. We used to do real estate debt. Again, most important, we only provide debt. and provide debt so as to get returns on a monthly basis. That's the objective of investments, what we had. And that's the thesis what we had from the day one. And from 2016, when we started doing it, we purely did from an NBFC and an alternate credit platform, which is a Black Soil India Credit Fund. From there, we have been providing debt to startup growth companies. In this specific space we talk about, right, which is the startup growth companies, right? And in this alternate credit space, overall, we have funded or provided debt to over close about 160 plus odd companies and already have made exits over 100 odd companies, right? The main objective of the group and the people behind this is provide debt to these companies and support them so as it would help them for the working capital requirements, right? Whereas the venture capitalist money or the VC money or the PE money, which can be utilized for the growth of the company. That was the objective which started the kind of a business, right? And have been providing respectively to various growth companies and the startups. Today, the fund which we had launched in 2020, which is on Black Soil India Credit Fund, right? On that side, basically, we have raised close about 280 odd crores and have funded typically close about 35 to 40 odd companies at this point of time. Just to add as well, Black Soil is backed by family office of Mr. Sashikaran Shetty of Alcargo Logistics, Mr. Sunil Gala of Navneet Education, and other marquee investors who are there, and been operated, and you can say the team has been operated by Mr. Moindapal Bansal and Mr. Ankur Bansal, respectively. This is about Black Soil in totality. Just to also further add, right, we have overall managing 4 SEBI-registered AIF, of which 3 were on the real estate side, 1 is on a non-real estate side, and in addition to that, we have an NBFC, and close about managing 2,000 odd crores of AUM across the entire platform. This is about Black Soil, right? And coming to the question, what we had about it, very tricky question that what kind of a returns would domestic investors would have generated. If you had asked this question 2 years back, possibly I wouldn't had an answer to give about it. I would have possibly stated only with the performance of what Black Soil would have done about it. But with the kind of SEBI, with kind of a rating agency like a CRISIL, a benchmarking reports which have been started from last 2 odd years, where we could have seen across that a typical return, a domestic LP, right, across the CAT2 funds have been generated on an average or a 10 years period has been around like 10% odd with the pooled IRR, right? But if you look across the funds, the schemes which have launched in 2019, 2020, I think they're fairly sitting with 17 to 17.5% kind of an IRR. That's the kind of a performance return which is there over the period of time, right? That's the performance which has been there. But just to give you a heads up on what we have been generating across all the platforms and has been distributing over 13.5% on a fixed income basis to the investors across various platforms of AIF what we have, right? Sorry, coming to your second question, right, which is about the banks investing. What are the options of banks investing? Right. So typically, if as per me, right, banks have typically 2 options to invest. One being a direct investment, which can they do in an AIF, right, and which kind of helps them. And those AIF which are backing startups or early stage companies, with that they can enable the growth which is there. That's one way the banks can look at it to invest in. And the second being is through a fund of funds, right? When I say fund of funds, basically investing in further AIF, which further has invested in multiple venture capitalist firms and the private equity funds. What advantage it gives is the fund of fund advantage it will give is it gives a portfolio diversification and a risk management, right? That's the advantage which banks would possibly receive it, right? When they participate or invest through a fund of funds, right? And sorry, and the last part of it, I think you mentioned what is more preferable, whether it's a venture capitalist or venture debt. I think over here, it is the preference of a domestic LP, right? It's purely depend upon his investment horizon, his risk appetite, what is more important, what's his time horizon, kind of investments which we intend to do it. Now, as a venture capitalist, right, someone wants to put a venture equity, He's investing money, he's putting capital for a stake in the company for a long-term perspective. Whereas on a venture debt, he is investing money, providing loans to startups or a growth companies at possibly a higher interest rate than what a bank would have offered to, right? To answer this question, it's very, very important. The risk tolerance of an investor is very important to understand where he wants to put the money. If he wants to put the money for a longer period of time, happy to be associated to generate higher returns, right? And be a part of a success story. And then that's possibly the venture capital would be the right answer for the person. But if the person is happy to generate returns on a predictable cash flows, comparatively lower return, right? On a fixed income basis, want to generate returns, I think that the venture debt would be the answer for that respective domestic LP or investor, basically. So it purely depends upon the tolerance of an investor, his own investment horizon period, and the need for where he wants to generate return about it. Yeah, that's from my side.
Thank you, Chiragji. I think you have rightly given the answer of both the questions. So return perspective. So now benchmarks are available. That's a good thing. So it's a published benchmark. Actually, there is no bias view on that actually, and everybody can see it. And we see the benchmark which you have told the returns and all. I think these are fairly good return in comparison to the other asset class. So that's good, one thing. And the second question which we asked, actually, you have given very, very, I think, answer in such a manner where the idea was just to basically understand from the PSU banks or private banks, but the banks, actually nature of business which they do generally the debt lending actually. And so the equity and debt, because now the venture debt are also, a lot of venture debt funds are there which are prevalent actually. So the idea was just to understand from their business point of view. I think the venture debt will be of more of I think suitable to them because they understand that asset class. So with what is happening, what we understand, because we are dealing as Resurgent India with all the banks regularly, and we are associated with them in many ways. So they always say that they don't understand the equity asset class actually. So they are keeping always try to away from the investment in the AIF actually. Most of barring 2 or 3 large banks in the country, most of the banks are keeping away. So this venture debt class, asset class can be one of the area where they might be looking at in a manner where it is similar to the business which they are doing actually. And as you told, the long term is also one of the aspects. So it will not be very long term also. And they can generate some regular return on that. So from that point of view, we thought that this question should be asked from you because you are into venture debt space. So we are also doing a lot of policy advocacy, a lot of handholding with the banks for investing in AIFs. Because initially they have invested in the equity AIF, but they could not come out with the in some cases with the exits, and also this asset class can be helpful to them to invest in the AIFs.
So just to add, Ashish ji, what you're mentioning is taking a direct exposure or giving a debt directly to X and Y startup is not easy for a bank, in spite they give a debt, because it's not a traditional company, right? They don't have a comparison factor for them to look at it whether, okay, can I give this debt to an X and Y growth company or a startup, possibly profitable at a contribution margin level? Can I give them debt? I don't think so. It fits in their idea as well. Things are getting changed, but it's gradually process which is there. So the main idea, what happens in that case is they can typically target to fund or give debt to those kind of companies through an AIF route. So there are few players who exist, players like us or the peers like us who are available in the market, who are providing either you say venture debt or alternate credit, right? Basis of that, they can provide debt to them respectively, and which further indirectly goes to startups or growth companies respectively for the working capital requirement. That is what bank typically expects is a regular cash flow of return, right? Which solves the purpose as well. But not taking away the fact that they don't want to invest in venture capital. They do want to parallelly, because the idea of any institution treasury is to blend the portfolio, right? Whether it's a combination of a debt and equity, that's how they want to blend to provide a kind of a blended return for the respective institution, right? And further, I mean, if they take a target with a fund of funds, the whole idea becomes this portfolio diversification, the risk management, right? So risk also parallelly reduces it because a fund is investing, which is further investing and multiple diversification across the portfolio, which is there. And that's how one can target to look at it.
Rightly said, sir. Rightly said. Thank you very much. Very well. Nothing biased to equity AIFs actually, but because the nature of business is a bank, so they are looking for this long term and the higher return. Then definitely the equity is one of the asset class or equity AIF which they are evaluating also. So thank you once again, Chiragji.
Thank you.
And now I'll come to the the last but not the least speaker, Mr. Brijesh Damodaranji, who is from Oxano Capital. So Brijesh, first of all, welcome to you and thank you very much for joining with us. Sir, we would like to understand about your journey, your Oxano journey actually, how you have come into this business and what are you doing actually. And we have some questions for you also. The one is very important question is the rapid response from foreign fund in the wake of economic uncertainty. Uncertainty in it's understandable. How can domestic capital support the startup ecosystem when there is a dearth of foreign capital? That's the first question which we have from you basically. And direct investing versus the investing through AIF. So many family offices have started investing directly. So what do you think this direct investing versus investing through AIF route? What turns out to be better for domestic LPs? So sir, over to you and thank you very much.
No, namaskar. And very glad to hear how this sector has grown, right from Dinesh ji to Sunil ji. So if I can give some data points in 2012, when the AIF came into play, the commitment at the end of the year was only 40 crores. And as we closed December 2022, the commitment was upwards of 6 lakh crores. So that is how the sector has grown. Yes, typically, yes, it's the venture debt has very important role. But having said that, that's a kind of confidence which has come into place. Coming back to us, we can proudly say that we have been, we in our earlier avatar, we have been founders. So had a corporate job, we started the wealth management piece, and then our wealth management client said, "Ki the startup space is growing. Why don't you participate or we participate through you?" And that is how Oxano came into play. We have a very simple thesis, so we like to put into next-gen tech-enabled consumer-focused businesses, which has a secular or a secular cash flow needs, and that is where, as Dinesh earlier said, we look into category creator, market owner, and that's how the whole process comes into play. So when we started out an SPV to test the waters. One of our very earlier investments was bought out by one of India's largest companies some time back. And then in 2019, we formed an angel fund. And with that, in 2022 March, we again formed a Cat 2 fund. So that is how we believe that this place can grow. Having a capital public markets background, we feel that the Indian economy is poised to grow both in the public markets and the private markets. And that is where our Cat 2 fund, which has an 40% exposure, if I can use that word, to public markets through the PIPO or listed or through the, and the startup phase. So this is a very interesting part. As I said, we had an exit in this quarter. We're looking for one more part exit, definitely. As Sunji said, jab paisa aata hai to nikal jana chahiye, not keep it forever, because cash is king, so should not become greedy and one should move forward. So that is the one part which comes into play. So with that as a base, and as answering to the first question, response from foreign funds and how domestic LPs can go. If you go back 10 years back or decade back, this was something like exotic product. But today, people are asking us. I'll give an example. When we went for the public market space, one of the senior person in the early 60s, and that was a woman. She said, why can't we allocate 25 lakhs to an AIF? Knowing fully well that, the risk is immense and what can happen. So that's the kind of, the interest which is actually coming in, and people are willing to allocate a certain sum of money to this asset class. And as data shows, this asset class is growing. Yes, today there are some dark clouds, but again, this will help the sector to grow. Earlier, we had was growth at all costs. Today, we're talking, musical words, which is good for the ecosystem and environment, which is like EBITDA kya hai, unit economics kya hai, what is the cash in bank, what's the runway. Earlier, this was not as stringently asked. So from that perspective, the domestic capital, which can be allocated, can grow and will grow. That is how the space is coming up. Beautiful question on direct investing versus AIF. See, हर चीज का segment होता है. So if family offices who have set up and they want to invest directly, absolutely yes, they can. If the cap table allows a larger sum of money to be invested in direct space. For early stage entrants or who was testing the waters, and who wants to have a professional approach, for them, definitely AIF is the recommended approach. But if you have the time, if you can do the due diligence, and if you have the money to invest directly, then yes. But having said that, both direct investing through family offices and the AIF, which is there in play, will definitely come into play. On the part of compliances, governance, and all, which is also a good, important thing. Now, as a fund, we had a compliance officer right on day zero. So we didn't, and this is our experience earlier. Myself being a chartered accountant and worked with Big Four, we thought we should do that. And again, what Alokji was talking about, can a secondary market for platforms should be there? Yes. In fact, one should look at a company called Private Circle, which is in the early stages of having a platform for secondary sale per se. So this is something which is there, which I thought I should also share along with the questions which you posed. Thank you, Ashish ji.
Thank you, sir. Thank you, Brajesh. I think you have very well covered about the journey of Oxano and gave us the insights of the investments, whether directly or through EIF. You rightly said. So, friends, now we have basically the time for the questions from the audience. So we have some questions which we have received. So the first question, which has been received by somebody, which is related to the overall capital, which is something around 8,50,000 crore, the AIF. How much is the domestic portion actually? So if somebody can take this question, that will be helpful to all of us. So because we have discussed in the starting also, initially most of the money came from the outside. So what will be the portion of the domestic capital in the overall capital? So Chirag, you would like to take this question?
Yeah, sure. I think the way AIF industry initially started, right, 12, 13 onwards, there was majority of a foreign capital which was there, foreign investors were there. But now as we move, the industry has evolved, right? And right now we are talking about 8 lakh crores of amount which has been there, 8 lakh crores plus, of which close about 70 to 75% is actually a domestic investors' money, right? That's kind of a shift which has taken place from that kind of a 14, 15 till right now, right? And the industry parallelly is also growing at close about a 50% CAGR for last 5 years period also. So yeah, just to answer it, yes, close about 70 to 75% of the current amount actually belongs to the domestic investor base.
So it's huge actually. 70-75% is really eye-opener for us also. The 70-75% money has come from domestic market.
That's
because
right.
Whatever the understanding of the people that this is reverse actually. So this domestic is lesser than the
when I was also reading to the materials and everything, right? And I also was a little surprised for the fact that, okay, is it really? But I think the shift which has actually taken, initially it was, yes, a lot of foreign investors, but myself, when I had looked across data multiple times and figured the fact that, it's the kind of money which has been received, which is purely from a domestic investors. And last couple of years, last 4 to 5 years, we've seen a lot of kind of a family offices setups which have been there, domestic institutions which have been there, right, which have kind of, and also the industry has parallelly opened up as well. It's been more organized as well, evolved as well, right? Basis the kind of a capital from a domestic has been actually moving across to the AIF aspect.
Okay, that's great. Dinesh, would you like to comment on that, or Amiji also, or?
Sure. I mean, as you pointed out, I mean, I've not seen the data lately on this topic. My impression was it's less than 50%, but maybe Chirag has seen the latest number. So I'm pleasantly surprised that it is domestic contribution has gone up to 3/4. I would have thought it's about half or less. So it's encouraging, very encouraging, and I think it will either stay or go up further in the coming years as more and more, like I said, old age capital also flows into this ecosystem.
Yes, 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 yes. Good. Amiji, would you like to comment on that also?
I don't have data, but definitely the domestic investment is increasing because government is also educating people on this particular topic, and I believe this will go up as well.
So Chiragji, we go in deep actually because this is a very important discussion which we have started and somebody asked. So out of this, you have given very eye-opener number also. So out of this 7, do you have any data also which can be break up that how much is from the family office, how is from the financial institutions, or from the PF funds or the government money?
Not,
This kind of data
not yet. I don't have further breakup of it, right? So I mean, can further dig down into it, right? But at this point of time, yes, I am only aware to the fact that major money, 3/4 of the money is actually from the domestic investors.
Okay. So I think we will go, Resurgent India will try to dig out actually, but we see the asset class which is doing very well and which is the LPs, which kind of LPs are doing investments in a big way, which are not investing. So which are not investing, this is the area where we can handhold them, we can have the discussions and we can bring them in the system. That will be helpful to the industry also. That will be, I think, help in the growth of the industry also. So great, sir. Thank you very much for your insights actually. And one more question is there from the audience side also, which is related to the LPG engagements. So are the LPs all basically looking as a financial investor, or are they engaging in the various aspects of the funds or the decision making of the funds also? So if you want to comment on that and what kind of LPG interests are there in the current scenario? Anybody would like to take this question?
Can I take that first?
Yes, sir, please.
So LPs typically who invest in AIFs, by design, they do not have a role in decision making of the fund. However, that said, there are some institutional LPs or anchor LPs who ask for some rights, and they may or may not exercise those rights, which is having a seat on the investment committee of the fund. But increasingly, given the governance issues, given the responsibilities that SEBI, accountability that SEBI is expecting from the ICs of the funds if things don't go well, etc., they're shying away, in our experience, from exercising those rights. So the short answer is when LPs invest in AIFs, they may have co-investing rights, and they obviously have access to information on what the fund manager is investing in, but they are not supposed to make the investing decisions on behalf of the fund. It's the job of the investment committee of the fund which does that. But regarding their leveraging, if they have any domain expertise or technical expertise, that of course fund manager is free to leverage, and it is always welcome. So fund manager should reach out to and ask for their views, opinions, or even involvement in any technical or domain diligence if an LP has specific expertise in any particular area that they're looking at a company in. Having said that, the situation is slightly different when it comes to angel investing or angel networks. I was talking about more VC funds. In angel networks, it's pretty common because a lot of angel investors become angel investors because they have 25, 30, 40 years of experience in a particular domain or technology, and they want to be associated with that. So they like to work with those portfolio companies. They like to become their mentors, sometimes board directors, advisors, etc. And they actively work with those companies.
Okay, great insights, sir. Great insights. Anybody would like to add in that? JC, would you like to add?
Yeah, I'd like to add. So, of late, we have also, we have LPs who have good industry experience, and we would like to, use their experience or leverage. So we are shared. If you'd like to share your information, knowledge with our portfolio companies, to start with on a pro bono basis, and then purely you connect and move forward. So we want to use the information, knowledge, understanding of the LP network, to grow. So we are doing something, on that lines too, on different line, though they are not mandated, but we do find LPs wanting to, contribute from that.
Okay, great. So the last question which we like to take up this forum. So this question has been asked by some Mr. Lakshmi Narayanan, that how the investor can believe confidentiality that the fund is playing exactly as per the rule book in terms of expenses, management fee, and calculation etc. So the one that this is on the basically accounting and transparency in the fund management. So I think there are third party auditors are there, and also if you can comment on that, sir.
Yeah, that's correct. So okay, so let me add that, and maybe Brajesh can also jump in. So basically, the fund is a very heavily regulated business. So we are subject to all kinds of third-party audits. In fact, as Sunil was saying, SEBI has been issuing more and more guidelines and circulars to protect the interest of the LPs, because it's a pooled capital and fund manager has a discretion to deploy that capital and make decisions around it. So 2 years ago, I think 2.5 years ago, there was a additional requirement introduced by SEBI for a third-party PPM audit. So now there's a PPM compliance audit also. So basically, we have to get an audit done by a third party. With a copy of that report goes to both the trustee of the fund as well as the SEBI, whether we are complying with our own PPM for that fund or not, in terms of strategy, style, whatever disclosures, whatever processes we mentioned in PPM, are we following that or not? So short answer, we are heavily regulated. So it's all to protect the interest of investors. Beyond compliance and regulations, most VCs, including us, we do at least minimum quarterly reporting to the LPs, where we disclose lots of things, not just about the portfolio, but also about how we are doing financially, where have we deployed the capital, what is the NAV, we send account statements to LPs, and of course, we remain open to any questions from them at any time. So that's how LPs can take confidence.
Good.
So I'll only add to what Dinesh just said. Besides on the reporting compliance part, every quarter one needs to report to SEBI and also share with the trustee. There's a CTR report which needs to be shared with the trustees. I think 2 quarters back, SEBI compliances, for reporting became much more wide and much more micro. So from that perspective, yes, compliance is there. There have also been reports that SEBI also stopped a few of the funds, the licenses too. So from that point, there is more than enough compliances in the way, and which basically as someone who manages money in a fiduciary capacity, that definitely takes care as we speak today as compared to what was there 2 years back.
Great. So friends, now I think we have already crossed the time limit. So I'd like to wind up the session, the permission. So I would like to thank you to all the panel speakers for their valuable time spending with us in this forum, giving their views openly, and I think your experience will definitely help, or I think will enhance the knowledge of the understanding of the people who have joined in today's webinar. So I would like to once again thank you to all of you for giving your time to us, and I would like to thank all the people who have joined in this forum, this discussion, and they have contributed a lot by way of asking the question and making it interactive. And I hope so that the people who have joined in this today's program, they must have gained some knowledge, or they must have some more clarity on the investment on the AIFs, or the investment side. What is the current scenario in the AIF industry from the investment point of view? And I think overall, in nutshell, what we can say that this a lot of investments is coming from the domestic LPs. And like somebody from the speaker side told that this is more than 70% the overall investment. So it's a very good sign, and the lot of checks and balances are there from the regulators. So It's not like that it's open field for everybody and everybody can take it granted. But there are a lot of checks and balances are there, and in terms of returns of the investors. So definitely the investors are getting good returns. The industry has now completed more than 10 years. So the benchmarks are available, the third-party reports are available. That's a good part. And other than that, exit opportunity. So definitely there are some challenges as of today because it's a asset which is a long-term asset. But hopefully in the near future, there will be some platforms where the liquidity will be available, where somebody want to exit, they can exit easily. So thank you very much. Thank you to all. And I would like to thank you to the Resurgent India team, this digital marketing team, the Deves, the Rohan and other members, and my investment banking team also, the Ojas and Dhruv and other members for making it successful. Thank you once again to all of you. Thank you very much. Good.
Thank you.
Right.
Thank you.
Thank you. Bye-bye. Bye, everyone.
Thank you, everybody. Thank you.